to start off with trying to put this rally into some type of historical context because it is a historic rally. Um, so if we're looking at a daily chart, every candle is one day. This is the S&P 500 from the April low. And as you can see from this low, we had the first move higher up to April 9th, and we had our first retrace right there. Now, in technical analysis, we measure how deep the retrace is. So what we do is we measure how big the move was, and these are retracement levels, Fibonacci retracement levels: 23.6, 38.2, 50%, 61.8. As you can see, this retraced more than half, 50% of the first advancement. Okay, that's pretty normal. That's pretty average when it comes to the first retracement of a new trend. This is where it gets very strange. So if we start on the new move higher and just measure each dip, this dip right here doesn't even make it to the 23.6 retracement level. That's rare. Here again, we don't make it to the 23.6, as is this one doesn't make it to the 23.6, nor does this one, nor does this one right here. This one right here didn't even come close. And this big one where we saw extreme fear to the level that we saw in April on this 3% drawdown didn't even come close to the 23.6 retracement level. It's very rare to see this. We have basically moved for 8 months and gone up 35% from this move right here on April 17th forward without seeing a dip that's retraced the 23.6 retracement level. Very, very, very rare. So how rare? Going back to the 1920s, there's only one instance where I could see that actually happened, and that was in 1998, October to July of 1999. We saw a 54% move higher, and this lasted for 9 months. We didn't test the 23.6 retracement on any of these dips, right? And I went through and looked at some epic market rallies. I mean, these are basically rallies that we had without seeing a correction, like a 10% correction, right? This was in 1994 to 1996, 53%. This went on for 76 weeks. Another epic rally, 68%, 61 weeks without seeing a correction. Huge rallies, 72%, 132 weeks without seeing a correction, a 10% drop. Here's another one in the 50s, 54% move, 85 weeks without seeing a correction. And another one, this went up 100%, over 105 weeks back in the early 1950s. Every one of these epic rallies saw multiple retracements to the 23.6 retracement level. So just to point out how extremely rare this is, there's only one correlation to it, which was in 1998 to 1999. And this went on for another month. It went up higher than we are right now as well. So interestingly, this is one of the cycles that I have been tracking. We have been tracking the 45-year cycle. It's treated us very fairly. It's been very accurate. I was looking for periods that line up with GAN cycles. 45 is a big one. The 52-year is a big one. You look at divisions of those, right? So 26 years is half of the 52-year cycle, and so you always want to look at that. What I'm looking for is within the GAN cycle timeframes, where did we see these really quick 2-month quick bear markets followed by epic vertical rallies? And 45 years ago in 1980, we saw that. The problem was that in 1980, as you can see, we did not make a lower low from this dip right here. And that happened, right? So this happened. We made a lower low breaking 550 a couple weeks ago or last week. And some cycle purists would say you got to scrap it. Others would say you got to give it some leniency. In my experience, it's starting to break. Cycles work until they break, then you find the new cycle that's working. The backup cycle that I have been tracking is the 26-year cycle, which lines up with this period where we've seen a vertical move higher without any retracements to the 23.6 retracement, right? It lines up perfectly. And in this cycle, we had this period where we saw a brief break to a new low right there, and then this push higher, which would be targeting kind of somewhere in January. Potentially, it could go up into late February, before seeing our first, noticeable correction, which would be a roughly 13% drop, before seeing the final blow off move. So this cycle is lining up pretty well so far, and we should see a continuation to new highs according to this cycle into the new year. Somewhere in January, February, we should see some kind of retracement. So this is the cycle that I'm following. Every cycle that major cycle I track, the 45, the 26, and the great cycle, the 60-year cycle, is suggesting bullish momentum up into the new year and a little bit beyond. The one bearish cycle that I'm tracking, the 7-year cycle, every 7 years, the market, you always want to track that cycle. That's a very important time frame. And it loosely lines up. It's not my favorite, but according to the 7-year cycle, I mean, we topped in late October, and we should see this kind of continuation lower. If we break out to new highs, this cycle is dead, and we are tracking the 65, probably some kind of combination mix, where we see bullish momentum into the new year, and then we'll take it from there. It's hard for me to get uber bearish, considering the AI super cycle that we're seeing and how a lot of these charts are lining up with this super cycle. To break it down for you, from the S&P 500 standpoint, this is a monthly chart of the S&P 500. This is 1999 top, 2009 top. That was a really large secular bear market, which was a fourth wave. We've been in this final fifth wave ever since, which has gone on for a decade plus. The count, just using pure technical analysis, says you could be approaching some kind of a top now. That doesn't really line up with what we're seeing in the economy, as well, and especially with this AI super cycle that we're in. And this green count, which is the primary that I'm tracking, has us pushing into 2026, which I'll go into right now. The pattern that we are in from the 2022 low, this overlapping messy move higher with big swings in both directions, best resembles what we call an ending diagonal. I've gone over this many, many times. You typically see it as the final fifth wave and a 5-wave uptrend that has extended too far. So the 2009 uptrend, the secular bull market, suggesting that, and if you do the measurements like the Fibonacci extensions, that third wave has definitely extended very far. So it makes sense. I've never seen an ending diagonal of this length. This is a multi-year ending diagonal. And the problem with ending diagonals is it's 3-wave moves in all directions. So it opens the door to a lot of possibilities on where it can go, how it can extend. This makes the most sense to me, that we'll see some kind of a move higher into the year end, followed by a correction. That would be your B wave, followed by your C wave higher into, maybe fall of 2026. There's a major time factor there, and then we'll see what plays out. So anyway, that's the kind of bigger time frame. And if we zoom in on what the structure is telling us from the April low, this is a very complicated pattern to analyze. I feel like every week that I change it. Very difficult to try to fit all these little dips into the larger pattern. This is what makes the most sense to me, is that from the April low, we have 1, 2, 3. There's an A wave, very shallow B wave. It's much more common to see a shallow B wave than to count this is A and this is B and see some really extreme C wave extend like that. That's extremely rare. So this is much less rare. It's rare, but it's not as rare as you may think. And if we follow the multiple counts, the red count basically says 1, 2, 3, 4 into mid-October, then 5, that would be into late October. And this would probably line up with a 7-year cycle where we see some kind of a vertical drop. That would be your B wave. Any kind of drop has to hold this level 55.36 to 52.51. I know that seems impossible that we'd ever make it down there before, but keep in mind we're dealing with a a very multi-year ending diagonal where you see extreme moves in both directions. I don't anyone that's been around doing this for since the 2022 low is probably wouldn't be shocked of seeing some kind of a vertical move then bullish momentum come back. Who knows? But anyway, if we break below 65.50, the odds of this start to increase notably. So that would be what's kind of like the what's going on and the back. So the blue count basically says that 1, 2, this is 3. We have some crazy fourth wave. This is A. We get a small B wave and then a push higher into mid to late December. Maybe, the turn of the year in late December, early January. And that would be the end of your A wave. And we'd see some kind of a bigger drawdown into Q1. The other scenario, which this is as far as I can extend this pattern, is 1, 2, this was 3, this is 4, and we get some kind of an extended fifth wave that could take you probably into late February for an even larger A wave. So this is what I'm looking for. Now, regarding our hedge, I said in our last webinar, when we broke 65.50, are we hedging the lows? It's a possibility. And I also said quite flippantly, I don't really care. And I know that probably frustrates people, but that's just the way that we look at this. We're an all-tech portfolio. We're a very high beta portfolio. We are seeking to get meaningful gains every year above major indexes. That's been our history so far. And how we manage risk is through raising cash and hedging. And so I look at hedging as a risk, as an insurance policy. In bull markets, it's quite frustrating. It'll drag. It could drag on returns potentially by 1 to 2% every year. Hedging here at the low, which felt like a low to me because of the extreme sentiment we were seeing, extreme momentum, dragged a little bit on our returns. That's why we layer into these hedges, and we got out of this hedge. Is there a chance that we break back down and have to re-hedge at 650? There is. And if that happens, that's what we're going to do. The whole point is to avoid being on the wrong side of something like that. And if we had a hedge, we actually front ran our hedge here. We weren't using this trend following kind of level-based system. We were hedged fully up in here, 100% right around in here. And then we kind of maneuvered it down to there. But anyway, that's how we look at this. Because the reality is, like, let's say a hedge eats away 2%, even 3% of the portfolio every year in a high beta portfolio. Yeah, that could be frustrating, but does that change one's life? Likely not. Being on the wrong side of something like 2022 in an all high beta portfolio with no protection, there are tech portfolios, total portfolios down 60, 70%. Does that change one's life? Yes, in a pretty meaningful way. Watching your net worth, drop 60%, that can change one's life in a pretty devastating way. So the whole point is to avoid being on the wrong side of that. And this is the IOFund solution. There are many solutions, but we talk about risk management regularly. And since we've been in a bull market, it's been quite frustrating. But what I've found, and this is one of the lessons I learned in 2021, is once you start making concessions on your hedge, which, back last week when I was like, are we hedging the low? Maybe. It looks like sentiment's extreme, momentum's extreme. We're getting some kind of, the rubber band is stretched very far to the downside. We're probably going to get a bounce. Once you start making, my experience is when you make concessions on a risk management plan, you'll continue to do that, or I'll continue to do that. And that's not what we're trying to do here. So anyway, if we start breaking levels, you'll see our hedge layer back on. And so we could get whipsawed. If that's the case, then that's the case. But anyway, I just wanted to say that. So anyway, this is the game plan right here. As long as we hold 655, I'm looking for maybe some kind of a drop that holds 685, somewhere around in there, and one more bigger push up to like 71, potentially 72 into year end. And if we really get going, then we could be looking at 74, potentially 78 into Q1. All right. If we look at other indexes, they seem to be lined up. The Dow, for example, is an incomplete uptrend. This is one, two, three waves up. We need to get a fifth wave higher, right? So this is kind of your higher quality, mega cap stocks. If you look at the Russell, it's an incomplete uptrend. We have A, B, one, two, three, four. We need a fifth wave push. Not sure how high that would go, but it's definitely incomplete as of right now. Semi's also an incomplete uptrend. This was an overlapping, messy fourth wave. Now we're getting a move higher, so we should get some additional push higher. However, look at momentum. You see how much higher it is right here than this high. So price is making a lower high, and momentum is making a higher high. This typically is what you see before you see some kind of a dip. Not saying we're going to see a drop back to here. We can see it break down towards, 291, even 278 and still hold this bullish uptrend. But we should see some kind of a dip before breakout based off what momentum's telling us. But once again, another market that has an incomplete uptrend that needs at least one more swing higher. And other markets, like let me just show you, these are the ones I track. I've been tracking divergences to help us identify weakness. You can do it in the opposite direction to identify strength. So these are indexes that are breaking out above the S&P. Small caps just barely poking above right now. Transports out of nowhere is starting to make a big bullish move. I mean, look, vertical move higher, breaking out ahead of the S&P. That's quite bullish. High quality value is also breaking out ahead of the S&P 500. And one of my favorite signals, this is an old world breadth signal, the advanced decline line. The way that I use it is it tends to have a remarkable history of leading the S&P 500, the broad market. And it broke out to new highs ahead of the S&P. And I can't remember an instance where I've seen that where the S&P doesn't follow. So we have, four markets that are actually, leading the S&P in a pretty meaningful way. The most intriguing to me is transportation stocks, which is very economically sensitive. Another one is ARC. It hasn't broken out to new highs, but this appeared to be an incomplete uptrend that needed to hit 101, from what I could tell at least. We held this 70 level, which was as low as I could give this fourth wave. And now we're getting what looks like a five-wave move off the low, which is pretty awesome. 1, 2, 3, 4. There you go, right there, 5. So we're getting some bullish patterns developing, which is kind of helping build the case for this move higher into year end. As long as 65.50 and SPX holds. The market internals are also looking pretty good. So I use most of these come from Wealth Umbrella. I think they have some of the best market indicators out there in terms of gauging market health. Just to kind of break it down, the options market, this is derivatives market. It's staying bullish. It's not breaking down to the sell side. It's starting to trend up, which is good. This is option flow, which basically leads the S&P by a few days. I mean, it just went vertical recently, which has been quite interesting. Realized volatility is starting to trend lower. Momentum broke out to a level that typically doesn't happen when you're in a B wave bounce. It just typically breaks out in a way that's signaling a new uptrend is happening. And breadth also recovered quite substantially in a very quick amount of time. So the only thing that concerns me is the skew index. As the market has been going down today to sideways, we've seen protection in the options market actually going higher. We want to see this move down towards your like 130s, 135, 140. That would signal that we're setting up for a multi-week, multi-month push higher. So all in all, I look at the internals and I say this is pretty good. Nothing's really concerning me right now. So it all looks pretty ideal and healthy to me. Once again, to sum it up, this is a historic uptrend. The last time this happened, it went on for another month, 9 months. It's the only historical correlation we have that I could find going back to the 1920s, over 100 years where this has happened. So at some point we'll get a correction. But we continue to see these dips and corrections as buying opportunities within an ongoing uptrend.